On the morning of December 18, 2023, a quiet yet seismic announcement rippled through the tech world. Adobe and Figma were calling off their $20 billion merger. There was no dramatic courtroom verdict, no public shouting match between CEOs, just two press releases issued almost simultaneously from San Jose and San Francisco, declaring the deal dead. For 15 months, this proposed union had been heralded as a game changer in the design software industry, a combination that could reshape how millions of creators work. Now it was over in an instant. When the deal was first unveiled on September 15, 2022, Adobe framed it as nothing short of visionary. Half cash, half stock, plus additional restricted stock units for Figma's leadership. The offer was designed to bring the cloud-native darling into Adobe's formidable creative empire. To many investors, it seemed like the ultimate power play, one that could secure Adobe's dominance for the next decade. To many designers, however, it was the start of a countdown to the end of Figma's independence. Would this merger fuel innovation on a scale the industry had never seen? Or would it smother the very competition that drove both companies forward? As the months wore on, that question became the central fault line in an increasingly global battle. Regulators in the United States, the United Kingdom, and the European Union each launched in-depth investigations, challenging Adobe's assertion that the two companies did not compete directly. For them, the concern was not just about current market overlap, but about the future, about how Figma's trajectory could evolve into a direct challenge to Adobe's crown jewels, and how that rivalry might vanish if the two were under one roof. By late 2023, the pressure was relentless. In Brussels, London, and Washington, the language from officials grew sharper, the deadlines tighter. Behind closed doors, executives made last-minute attempts to salvage the deal, proposing remedies and adjustments, but the tide was against them. When the decision finally came to walk away, it landed with both the shock of finality and the inevitability of a slow-motion collapse. Now, with a $1 billion termination fee changing hands and no merger to show for it, the design software world is left with a lingering, unresolved tension. Was this a victory for competition, preserving a vibrant field of creative tools, or a lost opportunity to combine the best of cloud innovation with the resources of a global giant? As the dust settles, the only way to answer that question is to look back to the origins of both companies long before they ever imagined becoming one.
Long before their paths collided in a $20 billion headline, Adobe and Figma were building their empires on opposite ends of the creative spectrum. Adobe's story began in 1982 in Mountain View, California, when John Warnock and Charles Geschke left Xerox PARC to start a company that would change digital publishing forever. In its early years, Adobe introduced PostScript, a breakthrough page description language that became the backbone of the desktop publishing revolution. Over the next 4 decades, the company expanded its reach through iconic products like Photoshop, Illustrator, InDesign, and Acrobat, tools that became industry standards for designers, marketers, and creatives worldwide. By the early 2010s, Adobe had successfully transitioned to a subscription-based model with Creative Cloud, securing a steady revenue stream and tightening its grip on the professional design market. But while Adobe was fortifying its dominance, a new player was quietly rewriting the rules of digital collaboration. In 2012, Dylan Field and Evan Wallace founded Figma in San Francisco with a bold vision to bring professional-grade design entirely to the browser. Instead of requiring expensive hardware and software licenses, Figma's platform was cloud-native from the start, enabling real-time collaboration across devices and operating systems. Designers could work together as easily as editing a shared document, eliminating the friction of file transfers, version conflicts, and platform lock-in. By the late 2010s, Figma's growth was meteoric. Startups adopted it for its accessibility and cost-effectiveness. Large enterprises embraced it for its collaborative power. While Adobe's tools remained unmatched in depth and polish, Figma carved out a rapidly expanding niche in UI and UX design, a segment exploding with demand as apps and digital services became central to every business. By 2022, Figma had more than 4 million users and counted companies like Microsoft, Google, and Uber among its clients. The design software market itself was shifting in ways that made both companies reassess their strategies. Cloud-based solutions were becoming the norm, not the exception. Remote work, accelerated by the pandemic, had permanently altered how creative teams operated, making real-time, cross-platform collaboration an expectation rather than a luxury. For Adobe, Figma represented both a threat and an opportunity, a young, agile competitor excelling in an area where Adobe's offerings lagged, and a chance to extend its dominance into the heart of the digital product design boom. For Figma, the idea of joining forces with Adobe promised vast resources, access to a global sales network, and integration with the Creative Cloud ecosystem, advantages that could supercharge its product roadmap. But the very strengths that made the merger attractive also set off alarm bells for regulators. Bringing these two forces together risked eliminating a rare, fast-growing challenger to a long-established leader. The convergence of these histories, the incumbent seeking to defend its empire and the disruptor poised to challenge it, set the stage for a deal that on paper seemed inevitable. What neither side could have fully anticipated was how quickly that paper would be tested by the most powerful antitrust agencies in the world.
To understand why the Adobe Figma deal drew such intense scrutiny, it's essential to look at the numbers shaping the design software market in 2022. Adobe was the undisputed heavyweight, controlling the professional creative tools segment with an estimated market share exceeding 70% across categories like image editing, vector graphics, and desktop publishing. Products such as Photoshop, Illustrator, and InDesign weren't just popular, they were deeply entrenched in corporate workflows, educational programs, and creative agencies worldwide. Figma, by contrast, commanded a smaller but rapidly growing slice of a critical niche, browser-based UI/UX design and collaborative prototyping. In that segment, it was widely regarded as the market leader, outpacing rivals like Sketch, InVision, and Adobe's own XD product. Analysts estimated that Figma's share in the cloud-native UI design space exceeded 50%, with adoption accelerating among enterprise clients who prized its real-time cross-platform capabilities. From a competition metrics perspective, this landscape set off alarms. The Herfindahl-Hirschman Index, HHI, a common measure of market concentration, was already high in creative software due to Adobe's dominance. A merger that combined the top player in traditional creative tools with the leading force in collaborative UI design risked pushing concentration scores to levels regulators classify as highly concentrated, particularly in overlapping functions like vector graphics, prototyping, and design systems management. Barriers to entry in this market were steep. Building professional-grade design software from scratch required years of development, specialized talent, and significant capital investment. Beyond the technical challenges, new entrants faced network effects. Designers preferred tools already adopted by their teams, clients, and collaborators, making it difficult for a fresh competitor to gain traction. Distribution channels, too, were controlled by entrenched players. Adobe's Creative Cloud ecosystem acted as both a delivery platform and a gatekeeper. In addition to these structural concerns, regulators had precedent to lean on. Past enforcement actions in technology and media sectors had established that mergers eliminating nascent competitors could harm innovation even if the companies were not yet direct rivals in every product category. Cases involving Facebook's acquisitions of Instagram and WhatsApp were frequently cited as cautionary tales, where early regulatory approval arguably allowed a dominant firm to neutralize potential threats before they matured. For Adobe Figma, the numbers painted a picture of a market where competitive pressure was already limited and innovation was heavily driven by a handful of players. The prospect of removing one of the most dynamic forces from that equation set the tone for the legal and political battle ahead. Regulators didn't just see a large transaction, they saw the potential end of a competitive era in design software.
From Adobe's perspective, the strategic logic of acquiring Figma was straightforward and compelling. The design landscape was shifting rapidly toward cloud-native, real-time collaboration, an area where Adobe's existing product lineup lagged behind. Adobe XD, its in-house attempt to compete in the UI/UX collaboration space, had failed to capture significant market share, despite the company's deep resources. Figma, on the other hand, had become the default choice for product design teams across industries, from tech giants to lean startups. By bringing Figma under its umbrella, Adobe could close this capability gap instantly and secure its dominance in a segment projected to grow at double-digit rates for years to come. On paper, the synergies were enticing. Adobe spoke of combining Figma's design DNA with the depth and breadth of Creative Cloud's professional tools. This merger could integrate Figma's design systems and prototyping with Photoshop's advanced image manipulation, Illustrator's precision vector capabilities, and After Effects motion graphics. The potential to create a seamless end-to-end design-to-production pipeline appealed to both companies' leadership and many of their enterprise clients. There was also a clear financial incentive. Figma's business model, freemium at the entry level with strong conversion to paid enterprise tiers, had proven sticky and scalable. Adobe envisioned cross-selling Creative Cloud subscriptions to Figma's millions of active users, while introducing Figma's collaborative platform to its own vast customer base. Such cross-pollination promised increased customer lifetime value and new upsell opportunities. Investors were told to expect efficiency gains too. Adobe projected that by merging engineering teams and infrastructure, it could reduce duplication in R&D and accelerate product development. Marketing and sales integration could cut costs while expanding reach. For Adobe, this was a way to secure growth in an increasingly saturated creative software market without relying solely on organic innovation. But beneath these optimistic projections lay the concerns regulators would later amplify. Some of the efficiencies hinted at in internal discussions were difficult to separate from potential anti-competitive effects. If Adobe folded Figma's capabilities into its suite, it could choose to sunset competing standalone products, reduce free access tiers, or bundle pricing in ways that made it harder for rivals to compete. In other words, some of the value to Adobe might come not from creating new markets, but from tightening its control over existing ones. For Figma, the rationale was rooted in scale and security. While the company was thriving independently, competing head-to-head with Adobe long-term would require sustained investment, global infrastructure expansion, and relentless innovation to keep pace with an entrenched incumbent. Joining Adobe promised not only financial resources, but also distribution power and integration opportunities that could propel Figma deeper into industries where Adobe was already entrenched. The pitch to the public and to regulators framed the deal as a fusion of complementary strengths rather than a cannibalization of competition. Yet the line between synergy and suppression was thin. That tension between the vision of an empowered, more capable design ecosystem and the fear of a consolidated, less competitive market would define the fight that followed.
When Adobe announced the acquisition of Figma on September 15, 2022, the headline number, $20 billion, immediately placed it among the largest software deals in history. The structure of the agreement was split between approximately half cash and half Adobe stock, with an additional component of restricted stock units earmarked for Figma's CEO Dylan Field and his team, designed to retain key talent through the integration period. The deal terms also included a substantial breakup fee. If the transaction failed to close due to regulatory intervention, Adobe would pay Figma $1 billion, an unusually large figure that underscored both the perceived value of the target and the high stakes involved. The timeline was ambitious but realistic for a deal of this magnitude. Initial expectations placed the closing in 2023, contingent on regulatory clearance from multiple jurisdictions. The process began with the customary filings to antitrust authorities in the United States, the United Kingdom, and the European Union. Early-stage reviews were expected to be completed within a few months, after which the companies would proceed to what they hoped would be routine approvals. However, given the overlap in certain product capabilities and the growing scrutiny of big tech transactions, both sides privately acknowledged the possibility of extended reviews. Key contractual provisions reflected Adobe's willingness to endure a lengthy process. The agreement contained exclusivity clauses preventing Figma from seeking alternative buyers and hell or high water commitments that obligated Adobe to use its best efforts to secure regulatory approval, even if that meant offering concessions or remedies. This language was intended to reassure Figma's investors and employees that Adobe was prepared to fight for the deal. The first milestones came quickly. Within weeks, news emerged that regulators were already signaling interest in a deeper examination. In the UK, the Competition and Markets Authority initiated a Phase 1 investigation by late 2022, while the European Commission and the US Department of Justice began gathering market feedback from competitors, customers, and industry experts. The so-called drop-dead date, the point beyond which the deal could be terminated if not closed, was set far enough out to allow for protracted negotiations, but the clock was always ticking. By mid-2023, the procedural calendar was dominated by formal inquiries, document requests, and preliminary findings from multiple jurisdictions. Each delay pushed the possible closing further into the future, and with every passing month, the likelihood of a quick resolution diminished. What began as a confident march toward integration was slowly turning into a high-stakes waiting game, one in which public perception, investor confidence, and regulatory momentum all had the power to influence the final outcome.
The initial market reaction to Adobe's announcement was swift and sharply divided. On Wall Street, Adobe's stock dropped nearly 17% within a day of the news, the steepest single-day decline for the company in over a decade. Investors questioned the staggering $20 billion valuation, which represented more than 50 times Figma's estimated annual revenue at the time. Analysts debated whether Adobe was paying a strategic premium to eliminate a dangerous competitor or overpaying for a company whose growth, while impressive, might slow under corporate ownership. Figma's employees and early investors, by contrast, were elated. The deal promised life-changing payouts for stakeholders and positioned the company as a headline-grabbing success story in the SaaS sector. Within the design community, however, enthusiasm was far from unanimous. Many longtime Figma users flooded social media with concerns about the future of the platform, fearing that integration into Adobe's Creative Cloud could mean higher prices, reduced free tiers, or slower product innovation. Industry rivals moved quickly to capitalize on the uncertainty. Sketch, Canva, and InVision issued statements highlighting their independence and commitment to open competition, hoping to lure away users who might be unsettled by the news. Canva, in particular, used the moment to promote its growing suite of design and collaboration tools, framing itself as the agile alternative to an impending Adobe Figma behemoth. The media narrative split along similar lines. Mainstream business outlets framed the acquisition as a bold strategic move by Adobe to future-proof its dominance, citing the company's history of integrating major acquisitions like Macromedia and Behance. Tech-focused publications, however, were more skeptical. warning that the deal could stifle the very kind of innovation that had made Figma so disruptive in the first place. Some headlines cast the acquisition as an antitrust test case in the making, predicting that global regulators would seize the opportunity to send a message to big tech. Consumer advocacy groups and digital rights organizations began weighing in almost immediately. Organizations focused on competition policy expressed concern that the merger would remove one of the few companies capable of challenging Adobe's dominance in creative software. They warned of a potential innovation gap if Figma's independent roadmap was subsumed into Adobe's broader strategy. By the end of the first week, the battle lines were already drawn in the court of public opinion. Investors were cautious, competitors were circling, and regulators were listening. The deal, barely announced, was already becoming a lightning rod for debates about consolidation in the digital economy, a spotlight neither company could easily escape.
As the dust from the announcement began to settle, the voices of those most directly affected by the proposed merger started to emerge. At the center were the designers, developers, and creative teams who had built their workflows around Figma's real-time collaboration and lightweight accessibility. Many of them worked in startups and mid-sized companies that relied on Figma's free or low-cost tiers to keep projects moving quickly without heavy infrastructure costs. For these users, the fear was simple, that Adobe's ownership could bring higher prices, reduced feature access, or a shift towards subscription bundling that forced them to pay for tools they didn't need. Enterprise customers, meanwhile, viewed the deal through a more pragmatic lens. Large corporations that already subscribed to Adobe Creative Cloud saw the potential benefits of tighter integration between Figma and Adobe's flagship products. For them, a unified ecosystem could mean faster project turnaround, fewer compatibility headaches, and improved security compliance. Yet even in these circles, there were private concerns about losing the competitive tension that drove both companies to release frequent updates and bold feature innovations. Figma's suppliers and technical partners also had stakes in the outcome. Cloud hosting providers, plugin developers, and integration partners depended on Figma's open API and growing marketplace. A merger risked changing the economic incentives or technical accessibility of that ecosystem, particularly if Adobe decided to centralize or restrict certain integrations. Consumer advocacy groups, including those focused on digital rights and market fairness, amplified warnings that the merger could harm not just professional designers, but also students, educators, and small creative businesses. In their view, Figma's accessible model had democratized high-quality design, breaking down barriers that Adobe's pricing structure historically reinforced. Absorbing Figma into a dominant incumbent, they argued, could reverse that progress. On the other side of the debate, some industry veterans and agency owners supported the deal, believing that Adobe's financial muscle and global reach could accelerate Figma's feature set and infrastructure reliability. They pointed to Adobe's track record of scaling acquired platforms like Behance into widely adopted industry staples, suggesting that Figma could follow a similar trajectory. Trade associations, particularly in tech and creative sectors, began quietly polling their members to assess sentiment. Early results hinted at a split. Those in competitive niches feared consolidation, while those operating within Adobe-heavy workflows welcomed the convenience of a single-vendor solution. By the close of the first month, one thing was clear: the stakeholders weren't just passive observers. Their feedback, surveys, and public commentary were filtering directly into the reports regulators were compiling. Every user story, customer complaint, and industry endorsement became part of the evidence that could tip the scales toward approval, conditional remedies, or outright rejection.
By late 2022, the Adobe Figma deal was no longer just a market story. It had become a high-priority item for some of the most powerful antitrust agencies in the world. In the United States, the Department of Justice's Antitrust Division began its review under the Clayton Act, which prohibits mergers that may substantially lessen competition. This was not a routine filing. From the outset, officials signaled an interest in whether the transaction would eliminate a nascent competitor in a highly concentrated market. a theory of harm that had gained prominence after criticism of earlier tech mergers like Facebook, Instagram. In the United Kingdom, the Competition and Markets Authority, CMA, opened a Phase 1 investigation in early 2023, gathering input from competitors, customers, and market experts. The CMA's framework focused on whether Figma's continued growth could evolve into direct rivalry with Adobe's flagship creative products, and whether removing that future threat would harm innovation, pricing, and consumer choice. As evidence mounted, the CMA escalated the process to a full Phase 2 review, a move reserved for deals with potentially significant competitive concerns. The European Commission, EC, launched its own formal investigation mid-year under the EU merger regulation. The EC's preliminary findings suggested that the deal could significantly reduce competition in the supply of interactive product design software and other creative tools across the European Economic Area. Their review process included issuing detailed questionnaires to industry participants and conducting economic analysis to assess market concentration levels post-merger. Across these jurisdictions, the procedural steps were deliberate and intense. The US DOJ's second request demanded thousands of internal documents, executive communications, and detailed data on product roadmaps, pricing strategies, and competitive assessments. In the UK and EU, regulators initiated market tests to evaluate the credibility of Adobe's proposed justifications and potential remedies. Underlying the legal framework were shared enforcement priorities, preventing dominant firms from consolidating power in ways that could stifle future innovation, maintaining diverse choices for consumers, and safeguarding competitive dynamics in emerging markets. The agencies were also keenly aware that this case had symbolic weight. It was an opportunity to show that modern antitrust enforcement could anticipate harm before it became irreversible. For Adobe and Figma, the gravity of being on multiple regulatory radars at once was impossible to ignore. Coordinating responses across 3 major jurisdictions required legal teams on both sides to operate almost continuously, preparing testimony, refining economic models, and crafting narratives that could withstand scrutiny from agencies determined to set a precedent. As deadlines approached for each agency's next procedural milestone, the regulatory risk shifted from a distant possibility to an immediate and potentially deal-breaking reality. The stage was now set for a battle not only over market definitions and economic forecasts, but over the very philosophy of how antitrust should function in the digital age.
With regulatory probes deepening on 3 continents, Adobe and Figma turned to a different battleground, shaping the public narrative. Lobbying firms in Washington, London, and Brussels were engaged to position the deal as pro-innovation and pro-consumer. In the United States, Adobe retained high-profile antitrust counsel and veteran Capitol Hill lobbyists who framed the acquisition as a way for an American tech leader to strengthen its global competitiveness against fast-growing foreign rivals. In the UK, advisors worked to assure policymakers that the merger would benefit the country's creative industries, highlighting potential investments in local talent and infrastructure. In Brussels, the messaging emphasized Europe's design community as a beneficiary of improved tools and resources. Across all jurisdictions, the strategy leaned heavily on the argument that Adobe and Figma were complementary, not overlapping, and that their union would accelerate technological advancement rather than suppress it. Public relations campaigns mirrored these talking points. Sponsored articles in industry publications profiled collaborative projects that could become possible under a combined Adobe Figma umbrella. Company executives appeared in interviews stressing their shared values, empowering creativity, lowering barriers for new designers, and fostering cross-platform collaboration. Figma's CEO Dylan Field was particularly active in outreach, assuring users that the company's culture and mission would remain intact. Grassroots-style initiatives also emerged, some genuine, others appearing to be orchestrated. Blog posts, LinkedIn endorsements, and conference panels featured voices from the design community speaking in favor of the deal, citing opportunities for integration and stability. At the same time, counter-narratives surfaced organically and through advocacy groups, warning of a creativity monopoly and urging regulators to block the transaction. Media reception was mixed. While some outlets amplified Adobe's framing of a technology partnership poised to benefit millions, others were skeptical, noting that the language closely echoed past merger campaigns that ultimately reduced competition. Social media, particularly among designers, remained a volatile space. Posts praising potential integrations often drew immediate rebuttals from those concerned about pricing, product independence, and innovation slowdown. As the messaging war intensified, regulators took note. Agencies in all three jurisdictions quietly monitored public communications for inconsistencies between what the companies said to the public and what they stated in confidential filings. Every optimistic press release or user reassurance had the potential to become a point of cross-examination if it diverged from internal projections. By the final quarter of 2023, it was clear that controlling the narrative was as crucial as presenting legal arguments. In an environment where public opinion could influence political pressure, Adobe and Figma were not just fighting a legal case, they were engaged in a battle for the perception of what their future together could mean for the entire creative software industry.
The first public hearing on the Adobe Figma merger took place in the spring of 2023 under the watchful eyes of regulators, industry stakeholders, and an audience that ranged from rival executives to freelance designers who had built their livelihoods around one of the two platforms. The setting was formal but charged. Rows of legal counsel, economists, and technical experts flanking the lead representatives from both companies. On Adobe's side sat CEO Shantanu Narayan, flanked by the company's general counsel and senior product officers. Across the aisle, Figma's CEO Dylan Field maintained his characteristic calm, accompanied by his co-founder Evan Wallace and a lean team of advisors. The hearing opened with the regulator's chair summarizing the core concern: whether allowing Adobe to acquire Figma would substantially lessen competition in markets for interactive design tools, prototyping software, and potentially overlapping creative software segments. The tone was direct. This was not a mere formality, but the first real framing of the legal battlefield. Adobe's initial presentation emphasized the complementary nature of the two companies' products. Slides displayed during their testimony highlighted how Adobe Creative Cloud tools like Photoshop and Illustrator served professional content creation at depth, while Figma specialized in real-time collaboration for UI/UX design. The implication was clear. Rather than eliminating a competitor, the merger would unite two distinct but synergistic tool sets to better serve the global design community. Figma's testimony closely echoed this framing, but leaned on cultural alignment and user benefit. Dylan Field spoke about expanding access to design resources, improving interoperability with existing Adobe tools, and safeguarding Figma's independence in decision-making, commitments intended to reassure both regulators and the user base. The questioning from regulators quickly cut through the optimism. Officials pressed Adobe on the status of Adobe XD, its direct competitor to Figma, and whether that product would be discontinued post-merger. They asked for concrete assurances that pricing structures for Figma's free and lower-tier plans would remain intact. Economic experts on the regulatory panel probed whether internal projections showed higher revenues stemming from reduced competition rather than organic market growth. Key exhibits during the session included side-by-side feature comparisons of Figma and Adobe XD, charts mapping user migration trends, and excerpts from industry surveys indicating that a substantial portion of design teams viewed Figma as their primary alternative to Adobe tools.
These materials underscored why the agencies were unwilling to take the complementary markets argument at face value. By the time the hearing adjourned, the contours of the conflict were clear. Adobe and Figma had delivered polished, tightly coordinated narratives, but regulators had signaled their intent to interrogate the deal's long-term effects on competition and innovation. Outside the chamber, reporters clustered around both CEOs, capturing carefully worded sound bites. For the public, it was the first glimpse of the high-stakes chess match that would unfold over the months ahead.
From the regulator's perspective, the case against the Adobe-Figma merger rested on a straightforward but powerful theory. Removing Figma from the competitive field would substantially lessen innovation and choice in the design software market. The argument began with Adobe's current dominance. For decades, Adobe's Creative Cloud suite had been the industry's de facto standard for creative professionals, commanding high market share across multiple segments: image editing, vector graphics, layout design, and more. While Adobe faced occasional challengers, few had been able to sustain growth in the shadow of its brand power, global reach, and deep product integration. Figma was one of the rare exceptions. Its cloud-native platform had disrupted the UI/UX segment, not only by offering a modern, browser-based alternative to desktop applications, but by redefining collaboration itself. Teams could co-edit designs in real time, regardless of device or operating system, a capability that Adobe had struggled to match despite launching its own competitor, Adobe XD. In regulators' eyes, this dynamic positioned Figma as a nascent competitor capable of expanding into adjacent markets, potentially eroding Adobe's dominance over time. The core concern was not limited to current overlaps. Even if Adobe and Figma could credibly claim that their main products served different purposes today, economic models and internal documents suggested that Figma's roadmap included deeper image editing, vector manipulation, and animation tools, functions that would put it in more direct competition with Adobe's flagship products in the near future. The merger, critics argued, would eliminate this emerging rivalry before it could mature. Regulators also pointed to potential harms in pricing and access. Post-merger, Adobe could alter Figma's freemium model, bundle it with Creative Cloud subscriptions, or phase out lower-cost tiers, changes that could raise costs for individuals, startups, and educational institutions. In addition, by bringing Figma's development under Adobe's corporate umbrella, the pace and direction of innovation might shift toward integration with Adobe's ecosystem, sidelining priorities that had made Figma popular in the first place. Another strand of the case involved interoperability and openness. Figma's API and plugin ecosystem had flourished in a relatively open environment, allowing independent developers to build tools and extensions that enriched the platform. Regulators feared that Adobe might restrict or gatekeep this ecosystem, reducing opportunities for third-party innovation and consolidating control over design workflows. Past enforcement history lent weight to these concerns. Agencies cited examples in the tech sector where acquisitions of smaller, fast-growing competitors had been followed by reduced feature development, price increases, or the retirement of competing products. The lesson was clear. Even absent immediate price hikes, the loss of an independent rival could have irreversible effects on market structure. In sum, the case against was built on the principle that competition today is not just about the present, it's about preserving the possibility of future rivalry. By folding Figma into Adobe, regulators argued the market risked losing not only a unique tool, but also the competitive tension that drove both companies to keep pushing the boundaries of design software.
Adobe's defense of the merger rested on a different vision of the market, one where the combination with Figma would expand choice, not limit it. The company argued that while both operated in the broad category of design software, their core strengths were complementary rather than substitutive. Adobe's flagship tools, Photoshop, Illustrator, After Effects, were built for depth, offering professional-grade capabilities that powered film studios, ad agencies, and global enterprises. Figma, by contrast, was optimized for speed, collaboration, and accessibility, serving product teams that needed to iterate rapidly in a shared environment. The core efficiencies, according to Adobe, would come from integration. A merged company could connect Figma's real-time collaboration engine
directly to Creative Cloud's deep toolset, allowing a designer to sketch a prototype in Figma, edit assets in Photoshop or Illustrator without export hassles, and push updates instantly to collaborators. This, they claimed, would streamline workflows, save time, and lower project costs across industries. Adobe also highlighted Figma's global infrastructure challenges. Scaling a browser-based, resource-intensive design platform to enterprise-level reliability worldwide required massive investment in servers, bandwidth, and security. As part of Adobe, Figma would gain access to a mature global delivery network, engineering resources, and compliance capabilities that could accelerate its roadmap and ensure stability for millions of users. From Figma's perspective, joining Adobe was a chance to amplify its mission, not abandon it. CEO Dylan Field emphasized that the deal would allow Figma to remain focused on product innovation without the constant pressure of competing against a giant with vastly greater resources. With Adobe's backing, Figma could explore adjacent markets, such as 3D design, motion graphics, and advanced illustration that would have been harder to enter independently. Consumer benefits, they argued, would be tangible. The combined entity could offer bundled pricing for customers who used both ecosystems, lowering total costs for teams that currently paid for separate subscriptions. Integration could also mean less duplication of effort. Features like asset libraries, design systems, and prototyping could be unified across tools, eliminating the friction that comes with managing multiple platforms. Adobe and Figma both sought to counter the loss of innovation narrative by pointing to Adobe's track record with past acquisitions. Behance, they noted, had grown in scale and features after Adobe's acquisition, becoming a global creative portfolio platform. Similarly, they claimed, Figma's team would operate semi-independently within Adobe, retaining decision-making authority over product direction while benefiting from shared technology and resources. At the heart of the case was a simple premise. The merger was not about removing a rival, but about creating a stronger, more versatile ecosystem for designers worldwide. In an industry increasingly defined by distributed teams, rapid iteration, and multi-device workflows, they argued the potential upside of combining Adobe's depth with Figma's agility outweighed the hypothetical risks regulators feared. For months, the battle between Adobe and the regulators had played out in filings, interviews, and economic models. But in the later stages of the review, a series of internal documents surfaced that regulators believed could tip the balance. These materials, obtained through formal discovery requests, painted a more candid picture of how Adobe and Figma had viewed each other before the deal was announced. Among them were strategy memos from Adobe's product teams discussing the persistent challenge of Adobe XD failing to win significant market share against Figma. Some slides described Figma as the category leader in collaborative interface design and outlined scenarios in which Figma's continued growth could threaten Adobe's position in creative software more broadly. In several instances, the document suggested that acquiring Figma was considered not only for the synergies it offered, but also to neutralize a competitor before it could expand into Adobe's strongest markets. Equally compelling to regulators was evidence from Figma's side. Internal product roadmaps showed features in development, advanced vector editing, richer image manipulation, motion design tools that would, if completed, place Figma in more direct competition with Adobe's core applications. These plans undermined the company's public assertion that their products were fundamentally non-overlapping. Emails between executives revealed pandib discussions about the pricing environment. In one exchange, leaders speculated that post-merger, the combined company could explore adjustments to Figma's free tier to drive more users toward paid subscriptions. While such changes could be justified as part of monetization strategy, regulators saw them as confirmation of potential consumer harm through reduced access and higher costs. Perhaps the most damaging moment came when a whistleblower, an ex-employee familiar with early acquisition talks, testified in a closed-door session
that the primary motivation internally was defensive. According to this account, the acquisition was less about creating new value and more about eliminating a growing strategic risk. These revelations became the focal point in press coverage and advocacy campaigns. Headlines shifted from debating abstract theories of harm to spotlighting tangible evidence of intent. Public opinion, already divided, began to lean toward skepticism as excerpts from the documents circulated online, sparking heated debates among designers, economists, and antitrust watchers. For the agencies reviewing the deal, the smoking gun wasn't just a single memo or email. It was the pattern that emerged when these pieces were placed together. Taken as a whole, the evidence suggested that the future competition between Adobe and Figma wasn't just possible, it was anticipated by both sides. Approving the merger, in their view, would mean removing that competition before the market and consumers could benefit from it.
As the investigations reached their most critical phase, both Adobe and Figma knew that a clean approval was slipping out of reach. Regulators in the US, UK, and EU began signaling that without significant concessions, the merger would not move forward. This opened the door to negotiations over potential remedies, conditions designed to preserve competition while allowing the deal to close. The most straightforward option on the table was divestiture. Agencies floated the idea that Adobe could spin off or sell certain overlapping assets, most notably Adobe XD. While on paper this seemed feasible, the product's diminished market presence and lagging development raised questions about whether any buyer could realistically revive it as a credible competitor to Figma. Regulators feared that a fix-it-first sale would simply hand off a weakened asset, failing to preserve meaningful rivalry. Behavioral remedies were also discussed. Adobe proposed commitments to maintain Figma's free tier for a set period, to keep its API open to third-party developers, and to preserve its brand and leadership team for a defined number of years. These measures aim to reassure regulators that Figma's culture of accessibility and innovation would remain intact post-acquisition. Yet enforcers were wary of such promises, knowing that behavioral commitments are difficult to monitor and enforce over the long term. Another remedy under consideration was a firewall arrangement, where Adobe would commit not to integrate certain competitive data or product roadmaps between Figma and its existing product teams. This could, in theory, prevent anti-competitive coordination while enabling shared infrastructure. However, regulators doubted whether such a separation could be maintained in practice, given Adobe's highly centralized management structure. In the EU, there was talk of partial functional divestitures, carving out specific feature sets from Figma to ensure rival platforms could still compete. But the complexity of disentangling a tightly integrated cloud platform made this solution technically daunting. Perhaps the most ambitious proposal was floated quietly in the UK, allowing the merger to proceed only if Adobe agreed to license Figma's core technology to competitors at fair, reasonable, and non-discriminatory terms for a fixed period. This, regulators argued, could keep the collaborative design market open while still letting Adobe benefit from the acquisition. Adobe resisted strongly, claiming that such licensing would dilute the strategic value of the deal. Through months of back and forth, it became clear that the gap between what regulators demanded and what Adobe was willing to concede was too wide. Each side was calculating the trade-offs, Adobe weighing the long-term strategic loss if remedies gutted the deal's benefits, and regulators measuring the political and market consequences of approving a merger that still carried significant risk. By the end of the negotiations, the remedies conversation had shifted from how to save the deal to whether the deal could be saved at all. The countdown to a decisive break was now measured not in months, but in weeks. The breaking point arrived on the morning of December 18, 2023. After 15 months of global scrutiny, countless hours of legal argument, and failed rounds of remedy negotiations, Adobe and Figma issued simultaneous press releases announcing they were abandoning the $20 billion merger. There was no court ruling, no dramatic antitrust injunction, just a mutual agreement to walk away, framed in carefully worded corporate statements. The official reasoning pointed to the absence of a clear path to receive necessary regulatory approvals across multiple jurisdictions. Behind the diplomatic phrasing lay the reality that all three major regulators, the U.S. Department of Justice, the UK's Competition and Markets Authority, and the European Commission, had signaled strong opposition to the transaction. Each agency had gathered evidence and economic analysis suggesting that the deal would substantially lessen competition, and none appeared willing to approve without sweeping concessions Adobe would not accept. In Brussels, the European Commission had recently issued its Statement of Objections, laying out a preliminary finding that the merger would harm competition in interactive product design and overlapping creative software markets. In London, the CMA's Phase 2 investigation had produced provisional conclusions that echoed those concerns. And in Washington, DOJ officials were preparing for the possibility of litigation to block the deal outright. The risk profile had shifted from challenging to nearly unwinnable. Internally, Adobe's leadership recognized the cost of continuing to fight. Even if a court battle could be won in one jurisdiction, aligning global approvals was becoming an impossible puzzle. The hell or high water commitment in the deal meant pushing forward at almost any cost, but the remedies being demanded, functional divestitures, mandatory licensing, and behavioral commitments would have stripped away much of the strategic value that had justified the $20 billion price tag in the first place. As part of the termination, Adobe agreed to pay Figma the full $1 billion breakup fee outlined in the original agreement. For Figma, it was an unprecedented windfall for a deal that never closed, capital that could be reinvested in its independent growth. For Adobe, it was an expensive and very public setback, a reminder that even the most resourceful tech giants are not immune to modern antitrust enforcement. The immediate reactions mirrored the polarized debates of the past year. Advocates for stronger competition policy hailed the outcome as a victory for innovation, arguing that it preserved an independent Figma as a vital counterweight in the design software market. Critics, however, lamented the loss of potential integrations and efficiencies that could have come from the merger, seeing the decision as regulatory overreach. What remained undeniable was the symbolic weight of the decision. The collapse of the Adobe Figma deal joined a growing list of high-profile transactions scuttled by antitrust scrutiny in the post-big tech reckoning. It signaled to boardrooms worldwide that the rules of the M&A game had changed, and that in the digital economy, the mere perception of eliminating future competition could be enough to kill even the most expensive deals.
The hours following the announcement of the deal's collapse were a whirlwind for both companies. Adobe's stock price, which had been under pressure since the merger was first announced, experienced a modest rebound as investors processed the end of what many had considered an overvalued transaction. Some analysts framed it as a relief rally, interpreting the breakup as an opportunity for Adobe to avoid overpaying and preserve capital for other strategic initiatives. Others saw it as a missed chance to secure a dominant position in the fast-growing collaborative design market, leaving Adobe vulnerable to rising competition. Figma, on the other hand, emerged from the wreckage in a far stronger cash position. The $1 billion breakup fee landed instantly in its balance sheet, a windfall large enough to finance years of product development, infrastructure scaling, and market expansion without needing additional investment. Internally, morale was mixed, relief among those who feared cultural dilution under Adobe's ownership, but also disappointment among employees who had been anticipating the resources and distribution advantages that a merger could have brought. In the executive suites, the fallout was more strategic than emotional. Adobe's leadership faced pointed questions from its board about how much time, money, and political capital had been spent pursuing a deal that regulators clearly saw as untenable months before it ended. The experience prompted a reassessment of the company's M&A strategy, with greater emphasis on deals less likely to trigger full-scale antitrust investigations. For Figma, the independence it fought to preserve, willingly or otherwise, now came with heightened expectations. Competitors like Sketch, Canva, and InVision were quick to seize on the narrative that Figma was free again, using marketing campaigns to lure designers and teams who might have been on the fence. At the same time, enterprise customers who had delayed purchasing decisions during the merger uncertainty began re-engaging, reassured that the platform's roadmap would not be subsumed into Adobe's. The wider industry reaction underscored the ripple effects. Investors in the SaaS and design tech space recalibrated their expectations for large-scale acquisitions, recognizing that high-growth startups in concentrated markets would now face far tougher scrutiny. For law firms and antitrust specialists, the case became an instant case study in how coordinated cross-jurisdictional enforcement could derail even the most resource-heavy transactions. Within days, Adobe's corporate communications pivoted to emphasize organic innovation, unveiling new AI-assisted design tools and upgrades to Adobe XD, an implicit acknowledgement that the company would need to compete head-on with Figma rather than absorb it. Meanwhile, Dylan Field addressed Figma's user community directly in a live-streamed town hall, reaffirming the company's independence and hinting at accelerated hiring and product launches funded by the breakup fee. The immediate fallout, then, was not simply a matter of share prices or balance sheets, it was the resetting of competitive dynamics. What had been a looming consolidation was now an open battlefield, with both companies returning to their corners, armed with fresh lessons and sharpened resolve for the fights ahead.
The collapse of the Adobe Figma deal sent tremors far beyond the walls of the two companies. In the design software industry, the decision was interpreted as a reset, a clear signal that the regulatory climate had shifted and that large-scale consolidation in concentrated digital markets would face unprecedented obstacles. Competitors moved quickly to exploit the moment. Canva doubled down on positioning itself as a cost-effective, feature-rich alternative, launching a series of updates aimed squarely at enterprise customers who might have considered switching to Adobe Figma had the merger gone through. Sketch, long considered a niche player after losing ground to Figma, re-entered the conversation with targeted marketing in regions where Figma's dominance was less entrenched. For smaller startups in the collaborative design and prototyping space, the news was a rallying cry. With Figma remaining independent, the competitive environment promised more room for differentiation and partnership. Some began exploring integrations with Figma's open API, confident that Adobe's acquisition would no longer restrict such collaborations. In turn, investors in the SaaS design segment grew cautiously optimistic, seeing that antitrust scrutiny could act as a guardrail to preserve opportunities for emerging players rather than letting them be swallowed by incumbents. The ripple effects reached other corners of the tech industry as well. Large software vendors, particularly in enterprise SaaS and developer tools, took note of how quickly a high-profile deal could unravel under multi-jurisdictional pressure. Boardrooms began factoring in the likelihood of drawn-out regulatory challenges when weighing acquisitions, especially in markets where network effects and high switching costs concentrated power in a few hands. Some corporate development teams started quietly shelving plans for category killer acquisitions, opting instead for smaller strategic buys unlikely to trigger formal investigations. Even beyond software, the collapse influenced public policy debates. Lawmakers and competition authorities around the world pointed to the Adobe Figma case as evidence that modern antitrust frameworks could address harm before it became irreversible. Advocacy groups used it to push for broader reforms aimed at curbing the power of dominant platforms. The narrative was reinforced by recent enforcement actions against big tech and other sectors, creating a sense of momentum behind proactive intervention. For the design community, the industry ripples were more personal. Freelancers, agencies, and in-house teams took the decision as reassurance that the tools they relied on would continue to evolve under competitive pressure. The very existence of two strong, independent players, Adobe and Figma, promised a faster pace of innovation and a check on aggressive pricing strategies. Yet there was also recognition that the rivalry would now be fought directly, and that Adobe's renewed investment in Adobe XD, bolstered by AI integration, would make the competitive landscape more intense than ever before. In the end, the deal's demise reshaped expectations across the industry. It was a reminder that market dominance is never permanent, that innovation thrives in contested spaces, and that the balance between scale and independence is a central question for the future of creative software. The ripples from December 18, 2023 were not just about two companies, they were about the rules of the game for an entire sector.
In the months after the Adobe Figma deal collapsed, its influence on competition policy became impossible to ignore. For antitrust enforcers, it was a rare, high-profile example of stopping a major transaction before it could reshape the market, an embodiment of the idea that competition law should address not only present harms, but also the elimination of future competitive threats. Regulators in the US, UK, and EU began citing the case in speeches and policy papers as a model for cross-border coordination. The alignment between the three agencies was notable. Each applied its own statutory framework, yet their conclusions were strikingly consistent. This became a case study in how agencies could share market intelligence, economic modeling, and investigative findings to present a unified front against deals they saw as potentially anti-competitive. For policymakers, Adobe Figma reinforced the urgency of updating merger guidelines for the digital economy. In the US, the Department of Justice and Federal Trade Commission referenced the case in consultations over new merger guidelines, emphasizing the importance of evaluating nascent competition and ecosystem entrenchment. In the UK, the Competition and Markets Authority used the outcome to validate its increasingly interventionist approach to technology mergers. And in Brussels, the European Commission treated it as evidence that proactive enforcement could prevent the concentration of market power before it became irreversible. The case also influenced legislative debates. Lawmakers who had been advocating for tougher digital competition rules pointed to Adobe Figma as proof that regulators could act decisively without waiting for post-merger harm to materialize. In several jurisdictions, it gave political momentum to proposals for sector-specific rules, such as the EU's Digital Markets Act or the UK's Digital Markets Competition and Consumers Bill, that aimed to impose stricter conduct requirements on dominant firms. From a legal precedent standpoint, the deal's collapse set a practical, if unofficial, benchmark for evaluating acquisitions of category leaders in emerging markets. It demonstrated that even absent direct, current overlap, the credible threat of future competition could be enough to block or deter a merger. Antitrust lawyers began advising clients to approach such deals with heightened caution, warning that killer acquisitions in fast-growing niches would be scrutinized not just for market share, but for trajectory. In the tech sector, this precedent shifted corporate strategy. Companies looking to expand through acquisition started rethinking the calculus, weighing the value of organic growth or strategic partnerships against the time, cost, and uncertainty of securing regulatory approval. Some began structuring deals differently, smaller stakes, joint ventures, or licensing agreements to avoid the appearance of full-scale consolidation. The Adobe Figma case will likely be cited for years as a turning point in the modern antitrust era. It was not a courtroom drama ending in a judge's verdict, but a strategic retreat forced by the weight of coordinated regulatory opposition. And in the evolving policy landscape, it stands as both a warning to dominant firms and a reassurance to challengers that the door to competition is not closed simply because an incumbent has the resources to buy the next big threat.
For executives, the collapse of the Adobe Figma merger offered a set of hard-earned lessons that extended far beyond the design software industry. The first and perhaps most sobering takeaway was the importance of timing. Adobe pursued Figma at the peak of its valuation, and just as global antitrust agencies were shifting toward a far more aggressive enforcement stance. Had the same deal been attempted 5 years earlier, before the heightened scrutiny of big tech mergers, it might have faced a smoother path. In 2022 and 2023, however, the regulatory environment had transformed into one where the very concept of eliminating a potential future competitor was enough to trigger deep investigations. A second lesson lay in narrative discipline. From the moment the acquisition was announced, Adobe and Figma faced a skepticism that could have been mitigated with a clearer, more consistent story. While the companies described their products as complementary, internal documents and market realities left room for doubt. Regulators seized on these inconsistencies, using them to challenge credibility. For future deals, aligning public messaging with internal projections and ensuring both withstand scrutiny is essential. Third, the case underscored the critical role of stakeholder engagement. While Adobe and Figma conducted outreach to customers, industry groups, and the press, much of the early conversation was shaped by vocal segments of the design community who feared losing an independent Figma. Competitors amplified those concerns, framing the merger as a threat to innovation. In today's environment, public sentiment can influence political will, which in turn can shape regulatory posture. Securing broad, visible support early can make the difference between a difficult review and an impossible one. Another takeaway was the danger of over-reliance on remedies to save a transaction. Adobe's willingness to discuss concessions like maintaining Figma's free tier or keeping APIs open was not enough to address core structural concerns. The remedies most likely to satisfy regulators, such as divesting Adobe XD or licensing Figma's technology, would have stripped the deal of its strategic purpose. This highlighted a strategic truth. If a merger's value depends on assets regulators are determined to protect, the odds of closing are slim. Finally, the experience showed that defensive acquisitions, those aimed as much as neutralizing a rival as at capturing synergies, are increasingly vulnerable. Even the perception of such intent can derail a deal. Future strategies will need to focus on organic innovation, strategic partnerships, or minority investments that avoid the appearance of market foreclosure. For Adobe and other incumbents, the lesson was clear. The era of unchecked consolidation in high-growth digital markets is over. For challengers like Figma, the case proved that independence can be a strategic asset, attracting customers, partners, and even investor confidence in the wake of a blocked deal. And for the broader market, it was a reminder that in the modern antitrust landscape, success isn't just about what you want to buy, it's about whether the world will let you. In the wake of the deal's collapse, the story of Adobe and Figma feels less like a conclusion and more like the opening chapter of a new competitive era. The questions left hanging are not just about these two companies, but about the future of the creative software market itself. Will Adobe double down on developing its own collaborative design tools, finally transforming Adobe XD into a true rival to Figma? Or will it pivot toward emerging technologies, AI-driven design, generative content creation, immersive 3D workflows that could redefine the market altogether? For Figma, independence is both a liberation and a challenge. The $1 billion breakup fee provides an unprecedented runway, but it also raises expectations. Investors, customers, and employees will be watching to see how quickly the company can leverage its freedom to expand beyond UI/UX design, potentially moving into richer motion graphics, illustration, or even augmented reality design spaces. The ambition hinted at in Figma's pre-merger product roadmaps will now be tested in real time without the cushion of Adobe's infrastructure or global sales network. In the broader industry, the open question is whether this case marks a permanent shift in the M&A landscape or simply a high-profile exception. If regulators continue to coordinate across jurisdictions, as they did here, other dominant firms may think twice before attempting to acquire fast-growing challengers. Yet, history shows that markets evolve, political winds shift, and strategic deals sometimes find new pathways when conditions change. There is also the possibility, however distant, that Adobe and Figma's paths could cross again, though not in the form of an acquisition. Strategic partnerships, joint ventures, or technology licensing agreements could emerge if market conditions make collaboration mutually beneficial without triggering the same regulatory alarms. In the meantime, their rivalry will likely intensify, with each seeking to out-innovate the other in a high-stakes contest for the loyalty of the global design community. For now, the Adobe Figma saga stands as a case study in how modern antitrust enforcement can alter the trajectory of billion-dollar strategies. It is a reminder that in a digital economy defined by rapid innovation and network effects, the question of what comes next is often more compelling than the outcome we just witnessed. The merger, may be dead, but the race to shape the future of design is still very much alive, and its next chapter is unwritten.